Hey there, navigators. Welcome back to What I Learned in College. I'm Sarah Luna, and today I'm going to be showing you how to maximize your FAFSA so that you can get as much financial aid as possible. FAFSA can be overwhelming, but if you use the right strategies, you can make sure that you qualify for every dollar that you deserve. In this video, I'll cover dependency status and overrides, income reporting tips, special circumstances and appeals, and extra strategies that most students miss. By the end, you'll have a step-by-step roadmap that you can use to maximize your aid, save yourself thousands, and avoid common mistakes. So let's get right into it. Let's talk about dependency status and overrides. Your dependency status is a huge factor in how much aid that you can receive. FAFSA classifies students as either independent or dependent. Dependent students must include parents' income and assets, while independent students only have to report their own. Most students are considered dependent, but you may be considered independent if you have certain circumstances, such as the following. You're 24 years of age or older. You're married. You're a veteran. You're a parent or you have dependents. Or you're orphaned, emancipated, or in foster care. Here's an example. Say you're 23 years old and you're living on your own. Well, FAFSA still counts you as dependent unless you meet specific exceptions. If you have, say, a unique situation like estrangement from your parents, right? You can request a dependency override where a financial aid administrator will review your case. This can dramatically increase your aid because FAFSA assumes independent students have fewer resources. Okay, so if you have some type of situation where you qualify for a specific exception to your dependency status, make sure you gather documentation like letters from counselors, social workers, or legal records to support your case, okay? Being proactive here can make a huge difference in your award, and if you can submit this documentation successfully to your financial aid administrator, it can affect your financial aid package tremendously. Income reporting is one of the most common mistakes that students make when they're filing their FAFSA. Incorrect reporting can dramatically reduce your aid. Remember, FAFSA uses prior year income. So, for example, the 2025-2026 FAFSA used 2023 income. And, 2024 income is used for the 2026-2027 FAFSA, and so on and so forth. Here's how to report your income correctly. Make sure that you use the IRS data retrieval tool when you're filling out the FAFSA to transfer tax info automatically, okay? This reduces errors. Also, include all required income, but be aware of untaxed benefits that may help, like child support paid for others, combat pay, or certain housing allowances that don't count as income. Here's another example. Say you earned $10,000, right, in 2023, for instance, and then say your parents earned $50,000 during 2023. The FAFSA would include both your income and their income for the expected family contribution, which is now known as the Student Aid Index, right? Of course, that's pretty much a given, but if your parents have certain assets, such as a 529 savings plan, for example, or other types of assets, these may not be counted, in the same way as income, which could also dramatically increase your aid if you report correctly. I'm going to go ahead and let you know that I don't know too much more about this type of reporting for the FAFSA. So if you need specific guidance, make sure that you reach out to a financial advisor or conduct your own research online with credible sources. My pro tip, regardless of your situation, would be to keep a running tally of all income and assets that could be calculated. And you can enter those into the FAFSA accordingly and consult financial advising as necessary. And of course, when filling out your FAFSA, double check your numbers for accuracy. This will save you a lot of time in the long run if something ends up being incorrect. Now, this tip is all about leveraging special circumstances. FAFSA allows for special circumstances that can increase your financial aid eligibility. These special circumstances include situations like job loss or significant income reduction, divorce or separation of parents, high medical expenses that are not covered by insurance, natural disasters, or other unusual hardships. If any of the above apply, or another unique circumstance that wasn't mentioned before applies to you, make sure that you reach out to your financial aid advisor for further assistance. Then you can submit a special circumstances form. It may not be called that with your institution, so make sure that you reach out to your financial aid office to find out what that is. But most financial aid administrators have a special circumstances form, or like an appeal form or something like that, that you can use to explain unique circumstances that could qualify you for additional aid. Here's an example. Let's say your parent lost their job in 2024, but the FAFSA for 2025-2026 uses 2023 income. So, of course, the FAFSA is going to think that your parent still makes that money, okay? So you want to request a reevaluation with the special circumstances form, or however your school does it, and see if they can adjust your financial aid package according to this special circumstance. This is called lowering your student aid index, and it's not the only way to do it. Any demonstrated need like this can be used to lower your SAI, so make sure that you ask your financial aid advisor for more assistance. Okay, now we're going to talk about maximizing your financial aid through timing and strategy. So submitting your FAFSA early is one of the easiest ways to qualify for a maximum financial aid package. Many state and institutional grants are first come, first served, so filing as soon as possible ensures that you're considered for all available funding. Here's an example. Some state programs only have limited funds. If you submit FAFSA late, you may miss out on these funds entirely. Other tips include reassessing your FAFSA on a yearly basis. Your family's financial situation may change. Even a small drop in income or increase in expenses can increase your aid. Also, check for untapped state and school-based grants. Some grants don't require extra applications other than the FAFSA. They automatically use FAFSA information. And I know you've heard this so many times, but double check for errors. Mistakes like incorrect household size, income misreporting, or missing signatures even can reduce your aid without you knowing. So here's another pro tip for you. Consider reducing your assets in a strategic manner. For example, savings could be placed in a parent-owned 529 plan, right, instead of a student savings account, because assets that are in the student's name count more heavily than if it's in a parent account. So careful planning like this can increase your eligibility. So here are a few less obvious tips to boost your aid legally. Submit an appeal if your financial situation changes mid-academic year. Stay on top of those scholarships that require FAFSA submission. Ensure you understand dependency overrides and special circumstance appeals for multiple aid cycles if necessary. And make use of your school's financial aid counseling. They are there for a reason, guys, to help you. So take advantage of this. And you'll avoid common mistakes that cost students thousands of dollars. And you won't have to worry about that because you'll be double checking those FAFSAs, right? If you found this helpful, make sure that you like this video and subscribe to the channel for more college tips. I'll see you in the next video. Happy navigating!